Hello everyone, welcome to the 13th of our ACCA P7 Advanced Audit and Assurance lecture recaps. This one was on the second of our completion lectures. What we looked at in particular in this lecture was going concern. First of all, the responsibilities with regards to going concern. Firstly, management have a responsibility, and that is to assess the entity's ability to continue as a going concern. They'll also have to make judgments surrounding that ability. The auditor then will consider the appropriateness of the going concern assumption. So the management assess the ability of the entity to continue as a going concern, and then the auditor considers the appropriateness of that going concern assumption. They'll also check that there has been adequate disclosures in the accounts and that the entity can continue for the foreseeable future. Key point, foreseeable future. So the auditor should, to do this, review the management future plans, gather evidence, and get management representations. So how do we do that? Well, various procedures to do this. First of all, analyse the management forecasts, interim accounts, management accounts, cash flow forecasts. Have a look at all of those post year end to see if the going concern assumption is appropriate. Does it look like this business can continue for the foreseeable future? So the forecasts, interim accounts, management accounts will give you some information on that. You can then examine the refinancing needs of the business. Are they going to need refinancing this year? If so, how are they going to do it? Have they got arrangements in place? Is that likely to happen? So examine their refinancing needs. Secondly, their litigation and claims. If there's any ongoing litigation or claims, you need to discuss those with their solicitors to see if that's going to have an effect on going concern. You'll assess the financial support provided, for example, by the banks, overdrafts, etc. Are those going to continue? Ability to fulfill orders. Have they got orders on the book that they're just not going to be able to fulfill? If so, that could be a going concern issue. And lastly, examine post-balance sheet events. We looked at it last time, but have a look at post-balance sheet events just to make sure that there's nothing there that impacts on going concern. So, what indicators should we be looking for from these procedures? Well, first of all, if your costs are increasing faster than your revenue, that'll be a key going concern risk. If you're having supply shortages, foreign exchange problems, if it's a failing industry, if your gearing is increasing, if there are large loans from directors to the business, if technology is changing very rapidly, very quickly and you can't keep up, or indeed the loss of key staff or of key customers, both indicators that going concern could be an issue. As well as that, we could lose a key supplier. If we have a contract to supply a certain product and we lose that supplier, that may affect our going concern. Lastly, that litigation that we talked about. If there's large litigation ahead of you, can that impact on going concern? Just a word on foreseeable future. What foreseeable future is held to be is the same as the management, and it's at least 12 months. So you're assessing for the same as the management, and that will be for at least 12 months. What about if you disagree with the going concern assumption then? Well, what you'll have to ask is that the directors restate the accounts, and that will probably be on a breakup basis. If the directors refuse, well then you're going to have to issue an adverse audit opinion, and we'll look at that in more detail when we look at reporting. If there's a significant doubt over going concern, i.e. a significant uncertainty, well, you'll have to disclose this, and that will be in the form of an emphasis of matter paragraph. And again, we'll look at that in more detail during reporting. That takes us on to the final part of the audit procedures, and that's to review the work. Talked a little bit about review earlier, but let's look at it in a bit more detail. So first of all, there'll be a detailed review. Now what this is, it's where the seniors review the juniors' work. Remember, a lot of these audit procedures will be carried out by junior members of staff, so the senior audit partner will have to review the junior work. You'll have those quality control implementations that we talked about earlier in the course. They'll review the working papers in detail to see that they are adequate and check whether the plan has been adhered to. They'll also see if any queries have come up on the audit and whether those queries have been dealt with is the key issue. Have those queries been dealt with? There'll then be a manager review. This is not examining everything. The detailed review will look in detail at the working papers, at the plan, at the queries, just to see exactly what was done and whether it was adequate. But the manager review is not examining everything. It's an overview of the file in general. It'll check, was the detailed review done? Are there any gaps in the work, or have all procedures been carried out? File condition, very important. The file needs to be neat and tidy and tied together in a suitable way. And are there any matters arising out of the detailed review? The partner review then, that will be the final review stage, top level review. It'll be the final opinion, i.e. the final opinion will be given at that stage, and any last issues will be cleared up. Others then, hot review we've looked at, and a cold review we've also looked at. Hot review and ongoing during the process before the report is signed, cold review after the report is signed. So what is the role of having review? Well, we want to make sure that the plan was okay. Did we implement the plan, and did it go according to plan? Was the plan flexible enough? When things came up, were we able to monitor the plan and change it? Has the work been done properly? Key one, has the work that you planned been done in accordance with the plan and properly? And is the evidence there, is it sufficient and appropriate, and has it reduced the risk of material misstatement? That's the key thing that evidence is there to do, to reduce the risk of material misstatement to an acceptable level. Has the opinion been supported, i.e. the opinion that you've given in your audit report, is it supported by the evidence that you have on file? So these are all things that will be looked at the review stage. Last procedures to be undertaken then. You'll undertake your analytical review. Remember that that's required under ACCA 520. And that will be a final check to see whether there is a true and fair view expressed, and whether you've applied the framework, or whether the management have applied the framework as has been their responsibility. You'll also check that all balances on the accounts have been substantiated, and go through the checklists that you have at the end. This will check whether all disclosures have been made and whether all accounting policies have been disclosed. And that was our lecture on the second part of completion.